Most people don't realize they're working roughly 110 days every single year just to pay taxes. That's more than 20% of your entire working year gone. No paycheck, no savings, nothing in your bank account. Just gone to federal income tax, state tax, self-employment tax, property tax, sales tax. And nobody talks about this openly. The math is sitting right there, but people never add it up. Today I'm showing you the exact calculation, and more importantly, what it reveals about how the system actually works. If you watch to the end, you'll see how some people legally cut this number down to 32 days, and how you might do it too. Most people think their tax burden is just whatever shows up on their 1040. That's federal income tax, and it feels bad enough. But that's only part of the picture. When you add up federal income tax, self-employment tax, state income tax, property tax, and sales tax, the real number gets shocking for a lot of people. Here's what we're calculating today. Take your total tax burden for the year, divide it by your gross income, then multiply that percentage by 260 working days. 260 working days is what you get when you take 52 weeks times 5 days and subtract roughly 10 federal holidays. That's your annual working year. Whatever percentage of your income goes to taxes gets converted into actual calendar days you spent working with zero income. It's a simple formula that changes how you see your paycheck forever. Let me start with someone most people can relate to. A W-2 employee making $75,000 a year. This is single income, fairly straightforward. Federal income tax on that is roughly $8,200. Self-employment tax doesn't apply because you're W-2. Your employer pays half the payroll tax without it showing up on your personal cost. State and local income tax varies widely, but let's use a $2,500 average, because some states don't have income tax at all. Sales tax is trickier because it depends on where you live and what you buy. But if you're spending about 30% of your income on taxable goods at a 75% rate, that's roughly $900. Property tax only applies if you're a homeowner. So I'm leaving that out of this basic example. Add those up and you're looking at roughly $11,600 in total annual tax burden. Take $11,600, divide it by $75,000, and you get 155% of your gross income. Now multiply that by 260 working days. 155% times 260 days equals 40 days per year, 40 days straight. That's 2 full work weeks where every single dollar you earn goes to taxes, not to you. 8 weeks if you stack them together. Most W-2 employees don't realize that's happening because taxes come out of every paycheck so gradually that it feels invisible. But it's not invisible, it's just spread across the year so your brain doesn't notice. This is where it gets worse. If you're self-employed, the math looks completely different. Let's take a self-employed person earning $150,000 in net business income. Federal income tax on that number is roughly $22,000. But here's what most people don't see coming. Self-employment tax, you're paying both the employee and employer side of Social Security and Medicare. Because you have no employer, that's 153% on $138,200. The wage base subject to Social Security tax in 2025. That comes out to roughly $18,913. State income tax, depending on where you live, might be $5,500. Sales tax adds another $1,800. Now you're at roughly $48,213 total. Divide that by $150,000, and you're looking at 321% of gross income. Multiply that by 260 working days. 321% times 260 days equals 83 days per year. 83 days, that's more than 17 weeks of pure work going to taxes. The difference between $11,600 and $48,213 isn't just a number on a spreadsheet. It's the gap between 40 days and 83 days. 43 extra days that W-2 employees don't lose to self-employment tax. Now here's the part that changes everything. That 83-day number isn't inevitable. For self-employed business owners, there's a legal strategy called an S-Corporation election that can cut that dramatically. Let me show you the same person earning $250,000, but comparing two different structures. First, let's say they stay as a sole proprietor. Federal income tax would be roughly $35,000. Self-employment tax on $190,000 subject to SE tax comes to about $29,213. State income tax around $8. That's roughly $72,213 total, or 289% of the $250,000. In tax days, that's about 75 days per year. Now let's say they elect S-Corp status instead. You set a reasonable W-2 salary for yourself. In this case, let's say $100,000. You pay payroll taxes on that 124% for Social Security and 29% for Medicare. That's roughly $10,169. You take the remaining $150,000 as a distribution, which is not subject to self-employment tax. Federal income tax on the full $250,000 drops to about $25,000 because of how distributions work. State income tax becomes roughly $6,500. Total $41,669. That's 167% of $250,000. In tax days, 167%, 43 days. The same person, same income, different structure. Just dropped from 75 days to 43 days. That's 32 days back in your life. At a conservative $50 per hour value, that's $12,800 worth of time reclaimed, and the best part, it's completely legal. Because you're following the reasonable compensation requirement under IRS rules. You have to pay yourself a fair wage for the actual work you do, but the profit on top of that, that's not subject to self-employment tax. This single decision can save thousands per year and shift how you think about your business structure entirely. Let's take this further and look at a lifetime perspective, which is where the real shock hits. Imagine someone earning $50,000 per year for 40 straight years from age 25 to age 65. Average tax burden across those decades is roughly 22%. That's $11,000 per year in taxes. At that rate, they're working roughly 57 days per year just for tax. Multiply 57 days times 40 years. You get 2,280 days. That's 625 years. 6.25 years of an entire 40-year career. Gone, not spent building a house. Not spent with family. Not spent learning or creating or resting. Just working to pay taxes. If you worked from age 25 to 65, that's a third of your adult life, from age 25 onward. This puts a number on what most people can feel, but never articulate the weight of the tax system is real. And it compounds because once you realize it, you can unsee it. Most people miss this entirely because they think about taxes one of two ways. Either they focus on the percentage on their tax return, I only pay 15% federal, or they feel stressed about taxes but never actually calculate the full picture. The second group is closer to reality, but they still don't have the number. Once you have the number, everything changes. You start asking, what if I could cut 20 of those 83 days down? What if I reorganized my income, my deductions, my timing? What if I moved to a state without income tax? What if I maximized my retirement contributions to lower taxable income? The answers to these questions aren't about being a tax cheat. They're about understanding that your tax bill is not fixed. It's a product of your structure, your location, your timing, and your knowledge. Let me show you how state location alone changes this math. Same person, same $150,000 self-employed income. If they live in California, state income tax might be $9,000. Total tax burden jumps to $51,213. That's 341% of income, or 89 days. Now put them in Florida, which has no state income tax. Total tax burden drops to $42,213. That's 281% of income, or 73 days. Same person, same income, same work, but 16 fewer days working for taxes, just because of zip code. That's not luck. That's not a loophole. That's just knowing how the system actually works. The US map of effective tax rates looks wildly different depending on where you live. States with no income tax cluster in specific regions. Florida, Texas, Washington, Nevada. These states don't tax income at all, but they make up for it with property taxes or sales taxes. So it's not a free pass. Meanwhile, California, New York, and New Jersey have combined state and local tax rates that can push high earners into the 3,540% total tax burden range. For someone earning $200,000, that could mean 40 extra days per year just from living in a high-tax state. Over a career, that's real money. It's also a real consideration when you think about where to live or run a business. Now let's talk about what you can actually do to reduce those days. The most straightforward move is maximizing retirement contribution. If you contribute to a traditional 401k, every dollar goes in pre-tax. If you're self-employed, you can contribute even more through a SEP-IRA or solo 401k. Each $10,000 you contribute reduces your taxable income by $10,000. If you're in the 24% federal bracket plus 153% self-employment tax, that's a $3,930 tax reduction per $10,000 contributed. You're not paying tax on that money. You're deferring. The tax days shrink immediately. Max contribution $23,500 in 2024 times an effective tax rate of approximately 39% equals roughly 39 fewer tax days. The second move is business expense optimization. For self-employed people and business owners, a $5,000 expense that's legitimate and documented becomes $5,000 off your taxable income. This is where people get confused. The expense still costs you $5,000 out of pocket, but you don't pay tax on that $5,000 of revenue. At 39% effective tax rate, that's $1,950 in taxes you don't owe. The problem most people face is they either don't track expenses carefully, or they get scared of audit and don't claim things they're entitled to claim. The system works against you if you don't understand it. Qualified business income deduction under Section 199A allows you to deduct up to 20% of qualified business income in many cases. That's an automatic tax reduction that most self-employed people don't fully maximize. The third move is timing of income recognition. If you're self-employed and you have a big contract paying in December, but you don't actually deliver the work until January, you can defer recognizing that income until next year. This isn't about being cute with the tax code. It's about understanding that the year you recognize income matters. 1 year of higher income can push you into a higher bracket. It can reduce retirement contribution deduction. It can affect how much tax you owe. Spreading that income across 2 years might save you thousands. The calendar is part of your tax strategy. Here's what most people never discuss: the psychological weight of realizing you work 83 days for taxes when you thought you only worked 40. That realization creates options in your mind. Suddenly, you're not just accepting your tax bill. You're questioning whether there's a better way, and often there is, not through anything sketchy, but through understanding and timing and structure. A person earning $150,000 as a sole proprietor working 83 tax days can legitimately consider an S-Corp election. A person earning $50,000 might be better served by maximizing retirement contributions and carefully tracking home office expenses. A person earning $250,000 might seriously consider whether they should relocate to a lower tax state if their business is location independent. These aren't fantasies, these are real levers that real people pull, and they all start with calculating your actual tax days. Most people never do this math. They pay their taxes, they feel the pain, and they assume it's fixed, but it's not fixed. Your tax obligation is actually a function of a system you can partially control. You can control the tax rates. You can control the brackets, but you can control your structure, your income recognition timing, your deductions, and sometimes your location. Let me show you how this looks across different income levels, because the pattern gets clearer when you see it stacked. A W-2 employee making $40,000 works roughly 35 tax days per year. A W-2 employee making $75,000 works roughly 40 tax days per year. A W-2 employee making $150,000 works roughly 50 tax days per year. Notice it's relatively flat. W-2 employees have less variation because taxes are withheld, and the system is standardized. Now look at self-employed people at the same income levels. Self-employed at $40,000, roughly 38 tax days. Self-employed at $75,000, roughly 55 tax days. Self-employed at $150,000, roughly 83 tax days.